If you hadn't heard, a bunch of Redditors recently took on hedge fund billionaires. By short squeezing the stock, the hedge funds themselves were shorting. The result? Hedge funds lost billions, GameStop stock rose 2,000% over the course of a single month, and a bunch of internet nerds made a ton of money. But now it's tax season. Certified public accountant and senior product specialist at Wealthfront, Tony Molina, said in a statement, quote, "Massive gains are great, but the recent trading frenzy is going to bring out a lot of short-term taxable gains, which have a much higher tax liability than the long-term capital gains many investors may be used to. So what does that mean for all of us who just joined in this stock market conversation recently? You're gonna owe. Currently, capital gains taxes have tiers of rates depending on how much you made and whether or not you held the stock for more than a year. So in the $0 to $40,000 earnings range for year-long holders, there's a 0% tax rate. But for around the same amount of earnings that were held for shorter durations, anyone who made around the same amount, or $40,525 in earnings, owes 12%, and it just goes up from there. Of course, there are ways to offset those taxes. Contributing pre-tax money to your 401k will reduce adjusted gross income. And Molina says if you have some failing securities, you can always sell them at a loss in what's called tax loss harvesting, using those losses to offset other capital gains.